There are two new covered call ETFs that were launched last month, and at first glance, they both look very attractive. In this video, I'm going to break down XQQI and EdgeX, where they may fit, and the key trade-offs you as an investor have to understand before jumping in. I'll compare how these two ETFs work, why investors are so interested in them, and which one may make more sense depending on what you're actually trying to do. Let's get going. Now, before we get going, I do have to put out a disclaimer that nothing in this video is financial advice. Please do your own research. Investing, of course, comes with risk, and always consult a financial professional. I'm going to start with XQQI, which is a boosted NASDAQ 100 high income ETF. And it's got a management fee of close to 1%, 0.98. These are the benefits of XQQI. The distribution rate noted here is 19 to 23%. That is their goal, annualized. Now take a look at number 2. The fund seeks tax efficiency using Section 1256 contracts, and that is something you should definitely take a look at. And the exposure to the underlying strategies of QQI combined with the boost of additional long exposure to the NASDAQ 100. Now, I do have to explain what Section 1256 contracts are because they're quite favorable. So 60% of the gain is taxed at the long-term capital gains, and that's a maximum of 20%. The other 40% would then be taxed at the short-term capital gains, and the result is a blended maximum federal rate of approximately 26 or 27%, which is going to be significantly lower than the top rate applied to ordinary income, which a lot of covered call ETFs fall under. So anytime I see 1256 contracts, I get very excited because it means more money in your pocket. The fund has already given 2 distributions. It started with 85 cents a share, and the last one in March was 81 cents a share. The top holdings for the fund are NVIDIA, Apple, and Microsoft, and rounding out the top 5 are Amazon and Tesla. The primary draw of the XQQI ETF is its ability to transform the growth-heavy NASDAQ 100 into a high-yield income engine. So we looked at those top holdings, right? NVIDIA, Apple, Microsoft, Amazon. It's clear the fund is riding the Magnificent Seven and the AI-driven tech wave. The reason this ETF is targeting a yield of 19 to 23% is because, unlike a standard index fund that only pays out a small dividend from these tech giants, XQQI uses a synthetic covered call strategy, and this allows it to generate significant cash flow from the volatility of stocks like Tesla, NVIDIA, and also many income funds like those focusing on utilities or consumer staples miss out on tech rallies. XQQI allows investors to keep a foot in the door of the AI and cloud computing sectors while still getting paid monthly. And last but definitely not least, I think it's very important, is its tax efficiency. Remember, XQQI uses Section 1256 contracts, which are going to offer you a tax advantage and are very efficient with how much money you actually take home. So XQQI is not a one-size-fits-all product. So given its structure and the holdings, it fits 3 types of investors, in my opinion. So one of them is the income-focused growth investor. So let's say you want exposure to the NASDAQ 100 because you believe tech is going to continue to lead the market, but you need current cash flow to fund your lifestyle, reinvest, or pay down expenses. And you're not satisfied with the sub 1% dividend yield of the round NASDAQ index. Second would be the volatility harvester. So since the fund generates income by selling options, it actually performs relatively well in sideways or slightly bullish markets. So, if you believe big tech has had its massive moonshot and will now trade in a choppy horizontal range, XQQI is a way to monetize that boredom. And the third one would be the diversified income strategist. So, if your portfolio is already heavy on value income, like REITs, as an example, adding XQQI provides a tech heavy counterweight and it allows you to maintain a high yield while diversifying the source of that yield into the semiconductor and software sectors. But I do have to caution you, though, that there is a risk. Because it sells calls against its holdings, I think this ETF is likely going to underperform a pure NASDAQ 100 fund like Triple Q during a massive vertical bull market. So you're essentially trading some of your upside for immediate cash in hand. The other newest fund I'm going to talk about is EdgeX. It might be known as EDGX in some circles, and it's a US 500 income fund. So some key takeaways from EdgeX is that it's a weekly source of income, and they're targeting a 9% annualized distribution rate. The portfolio managers are going to be selling call options, and they're going to be adjusting set positions based on market conditions, seeking to navigate the volatility and maintain exposure for potential upside capture. And EdgeX offers that market exposure to the largest 500 US listed equities as defined by Selective. Now, what Selective is it's a company that creates indices. And for this one, they created a specific index that EdgeX is going to be using to determine which are the 500 largest equities. So the top holdings for this ETF are BNY Mellon, which is investing in the largest equities in the United States, and VU, which is the Vanguard S&P 500 ETF. I also wanted to post here the most recent distributions. Again, this is a new ETF, so there's not too many, but here you go. So in my opinion, the reason that EdgeX or EDGX is known in some circles, it's getting a lot of notoriety is because of the variable option coverage. And this is a game changer. So EdgeX doesn't always cover 100% of the portfolio. On average, it aims to cover only 25%. So what this means for you is that in a massive bull market, 75% of your holdings are uncapped, and that allows you to participate in the rally. Also, by using weekly call options instead of the monthly ones, the portfolio managers can recalibrate 52 times a year. So if the market dips on Monday and recovers by Wednesday, they haven't lost a whole month's potential. They just reset for the following week. And unlike funds that pay out whatever premium they happen to catch, EdgeX is outcome oriented. So they target a steady 9% annual distribution rate, adjusting the strike prices and coverage levels weekly to hit that specific number. In my opinion, there's two investor profiles for which EdgeX might make sense. And I like to call the first investor profile the tactical satellite. So let's say that you have 80% of your portfolio in a low-cost core index like VU or SPY. But if you were to rotate that remaining 20% into EdgeX, you would be adding essentially a satellite with a booster, because you would be getting a higher yield than the 1% you're getting from a VU or SPY. But remember, because EdgeX only covers roughly 25% of its portfolio with calls, your satellite still captures 75% of the market's upside, which would be very important in a bull run. And you get, of course, that yield boost without sacrificing the core growth of the S&P 500. The second ideal investor for EdgeX, and again, this is my opinion, is the one that is worried about NAV. So if you were to replace a fund like QYLD as an example, that is a 100% covered call with EdgeX to stop the NAV erosion. Because high yield funds often suffer from a slow death, where the share price never recovers because the upside is 100% capped. And this is a solution that EdgeX provides for you. Again, 75% uncapped upside, and there's a weekly reset as well. So why wait 30 days when EdgeX resets every single week? So if the market was to rip on Monday, you're not locked out for a month. You catch a new price level in a matter of days. Thank you so much for watching. I hope you found value in this episode. It's a little bit longer than typical, yet I felt the need to really go in depth into these two new ETFs because it's getting a lot of notoriety among the investor community. If you like this video, please hit the like and subscribe button and make sure to share with other fellow investors. And my goal is to put out a new piece of content on Covered Call ETFs every single week. Thank you so much for watching, and I will see you on the next episode. Have a prosperous rest of your week.